The S&P 500 continues to work itself higher and higher, making a new all-time high today, getting past the Fed event and heading into that large option expiration, which is going to bring in some more volatility and free up the market for some more movement. This move higher is giving us that illusion of safety, thinking that the market can never fall, creating FOMO. Participants miss the rally, or FOMO, that they should have had more exposure in. On today's stock market brief show, I'm going to share with you what I've been doing with my portfolio, show you the statistics, show you some of the positions, but then I'm going to show you some of the cracks that are forming still in these markets, some divergences that are currently building, because the only thing that we do have complete control of is what we risk in these markets. So if you start focusing on narratives and less on risk, it pulls you away from the thing that you actually have control of. Let's get into today's show. All right, ladies and gentlemen, welcome back to the Stock Market Brief Show. And we're looking over here at the daily chart of the S&P 500. It continues to kind of press itself up higher. In the prior video, we talked about how we had this day down of volatility to start the month off, and then we kind of just drowned up higher. What is interesting is in August, we kind of did the same thing. The first day down, right? And then we just went a little bit higher, staying within this bull channel. Then I realized, oh, wow, actually, if you go back to July, the very first day was the low of the month there. And then also, if you go to June, right over here, the low of the month for that specific month was on the first day. So the first day here, the first day here, the first day here, and the first day here were all the lows for the month, as this kind of just bull channel holds tact. Now the RSI is moving into that overbought condition. It's not there yet. It's at 69.79. Remember, overbought can remain overbought, but we also have that bearish divergence that's still forming as it stands. Now for me, what I've been doing in my portfolio, as I've been saying, the market conditions, which we'll go over today, are still well within bullish conditions. But when we start to get extended, when we start to lose the ability to see systematics such as CTAs and vol control funds to be bigger buyers, what I do is tend to start reducing the portfolio exposure. So I'm showing you the portfolio today. This is just my top 3 and bottom 3 performers today. So I did do this on live stream. I added in a Halliburton name, just a pilot position there. UNH was down slightly. I'm up over 35 to 40% on UNH. And then DIY, this is one that I talked about heading into this year. I'm well up in that position too. CrowdStrike was up 12%. LEU was up 14. I'm up over 50% over here. And then Intel today had some news. And we also saw like semiconductors like NVIDIA take off today. And that one was up 22%. Now, the reason why I'm doing this to brag, the reason why I'm sharing this is because on a recent tweet, right, we discussed that I was 35% cash, 65% invested. And even with that, today's market performance, my portfolio outperformed the market. So if I wasn't 100% invested in the S&P 500, but only being in 35% invested, I still was able to outperform the S&P 500. So as the market presses higher, and I'm still getting exposure into names like Coin, Intel, CrowdStrike, LEU, I'm able to trim some of that performance, which creates a larger cash position. Now, as of right now, I'm 33% invested in the markets, and there was some structural difference from the last time I shared this, from 35% to 33. I was short DUST, the miners, and now I'm locked in green on there. I took profits the prior trade day and today's trading session in the morning. So that was 5 or 6%, 7%, somewhere around there. And I have a couple runners on. So I went from having a decent position there, just over pilot, I guess, which is good. It's just a little bit more because it's leveraged. And now I've rotated into some lower beta names. Now, as most of you know, the names that I look for are names that are pulling into main areas of concentration and they're contracting, and they offer up good risk to reward. So I figured I'd just kind of share with you what that might look like. If you're in the Discord, you saw this one. This was CRWD. There's plenty more you can go through. There's some winners, there's losers, there's all kinds, but all of them that I post all point to clear levels of risk and markets typically contracting, because when that happens, you can have some of your biggest moves. So this was on 9.4, right? CRWD. It was another interesting setup coming into an interesting area here. I took a position. This is what it looked like coming off, and then I sold not only just some here, but I sold some into this range here. I don't have the exact numbers here. But so what I do now is on a big day like this, I sell into that and then I just update my stop to the low. So I'm locked in. And if this thing wants to keep going, awesome, keep going. And what's this been doing for me? Well, for the last month, I'm up about 4.39% in my portfolio. This is the one that's verified in the United States Investing Championship. The S&P 500 is up 2.48%. And I'm getting this with what? With actually less, with a lot of cash still at hand, ready to deploy if it makes sense to do so. Here's the P&L curve over here for the last month. I did just hit today. This is going to be going up, and I did just hit with, I mean, obviously with all those other names that just performed, okay, and I reduced that those names that obviously went up, but I just hit an all-time high there. And from a year-to-date perspective, I'm about 39%. Coming into tomorrow, it should be 40+%, and that is what I am doing there for the portfolios. And the reason why I'm sharing this once again is a lot of people instantly assume that when I start talking more about risks, that it's bearish, that it means short the market. And if you actually watch the full videos, that's actually never the case. I rarely short. And if you're in the Discord, you already know this. So I'm not really talking to you. I'm talking to people that aren't in there or in the Patreon. But my goal here is my main goal here in trading, and before I get into the other charts, is to make the most amount of money in the least amount of time with the smallest amount of risk. And in order to do that, I need to play stocks that are in positive trends with good contractions. And if they're not in good trends, I have to do smaller positions. And then I have to play the breakout. And if it breaks out in my favor, it gives me a small risk. And if volatility expands, I can get out, scale out quickly and let it go. And that's what happened in these names like CrowdStrike, with Intel, with LEU, right? LEU being up 50% from the original purchase. That is what I've been doing. That's what I continue to do. And if you want more kind of a sneak peek behind the scenes, you can always join into the Discord, Patreon. There's a community there and some other great chartists as well. Now, I want to hop over into the intermarket standpoint of what's going on. Now, the S&P 500, right, as people are getting all this FOMO and, oh man, it keeps on going higher and higher. We're up about 3% from a year-to-date basis, or maybe 2.5 to 2.68%, somewhere around there. And we're floating around after the Fed meeting. We're holding up fine right now. Let's look at the intermarket stuff. The dollar has been down, the 10-year yield has been down, and that is what's been driving this S&P 500. Today, after the Fed rate cut and how the markets digested, the dollar actually went from a pretty significant sell-off, and then it completely reversed course and then had some follow through today. The 10-year yield also, right, as soon as the Fed cut rates, it went down, but now it's starting to show strength. So if that is actually going to continue, as we've been pointing out, some seasonality around this time of where the dollar finds a bottom, right, in September, based off of Trump's first term in 2017 and some other seasonality charts. If this starts to bounce up into October, if this starts to bounce up some more into October, is that going to stall out the bid in the overall markets? And that is what the current correlation tells us, at least right now. And if we take a look at the 10-year yield, you can see here, we did have a pretty big breakdown, and you can see we had a pretty big reversal candle and some follow through there. Still, the price momentum oscillator, it's kind of curling, but it's still rather bearish. And if you look at oil did find a low right over here, and it started bouncing, giving us insight that we might see the 10-year yield bounce in the very near future. It's like we've been saying, it's a good leading indicator. And now, yes, it's bouncing. So we'll see if oil starts to rise from here too. That could be a little bit of a concern, indicating that we could see higher yields even after the Fed cut rates. If we look at the dollar did hit that new low here in September, still have a positive divergence on the RSI, but as you can see, it's clear as day. We still are in an overall downtrend in the dollar. Lower highs, lower lows, yes, we have positive divergences, and if this were to break higher, still, if you look at the seasonality of what happened in 2017 and prior, you can see weakness into the year end, which has been beneficial. If you zoom out further and look at the dollar, we talked about this chart, how when we come down to this lower portion of the channel, which, by the way, I posted this in the video, and then all of a sudden every big person on Twitter started posting the dollar in a 14-year to 18-year channel. It's like, come on, people. Holy moly. But yes, we are in this larger term channel, and you can see once we're at the lows of these, it's indicated areas of caution, but it's been great opportunities to buy when you've been tagging those upper end of those channels. So the thought here is if we do break down further, that could be quite beneficial for some sort of a blow off move in assets that have negative correlations to the dollar as it stands. Now, I don't know if those correlations are going to start to begin positively correlating. I don't know, but if this also remains negative and this starts bouncing up from here a little bit, maybe perhaps back to 100 to 102.5, where you saw this kind of, I'll draw it out here, you kind of see this resistance turns support. So if we were to come back into here and then lower, maybe perhaps that pauses things off for a little bit and we kind of see what happens. Okay, here's the BP NDX chart. We did have a bullish divergence and now we're starting to move up a little bit more. It's still not way up here by any means and it's not an overbought condition, but I wanted to show you that the bullish divergence in there played out. I showed you that on the BP INFO chart, how it was forming here. And I do want to call out that this one is moving into that overbought condition now, 70.44. And you can see when it gets overbought, it's time to watch for those divergences to build because it has led to sell side and consolidations in the tech space and whatever sector we're looking at for in terms of the bullish percent charts. If you look at the bullish percent chart for the Nasdaq composite, this one has hit a new high, actually, a high that we haven't actually seen for quite some time. And you're starting to see a divergence here build. So this is getting a stronger reading. The RSI, it's not as high of a reading as it was over here. So the negative divergence in the Nasdaq composite, which is a broad market, is now starting to get to the point of a negative divergence building as it stands. Now, there's some other divergences that are building into the market. I want to talk about this one, and this is the housing index. Now, a while ago down here, we were talking about how as the S&P 500 was breaking to these highs and that this wasn't, this would either mean one of two things, that this has to play some big time catch up or it's a bad sign for the S&P 500. Well, this played some big catch up. However, what do we notice? We still haven't actually broke the high from over this point. You might be saying, well, why is that important? Well, if you just look through history, you can see many times that this divergence has happened where the housing market puts in lower highs, then the S&P 500 puts in higher highs, and it just wasn't a confirming indicator looking at the housing, and it gave us insight to potentially selling. You can see it over here. We had matching highs while the S&P 500 continued to climb higher for about a year, and then it led to a 2022 bear market. On the flip side of this, it's also a bullish indicator too. You can see we put in a new higher low over here at the bottom of October in 2022, and yet the S&P 500 was going lower, and the housing market was indicating to us, hey, perhaps we're looking for a bottom, and we started to take off from that point. Now, if you want to zoom out further, why it's also important is this was a huge indication that something was not working as we were leading into the financial crisis. In 2005, right over here, the housing market hit its peak. Now, from 2005, the S&P 500, yes, it went higher. We saw some volatility right back down, okay? And then we continued to press higher in this monstrous type move to the upside, and yet this was unconfirming. It never confirmed that move. In fact, you can draw this out like that and like this right here too, and it led to a financial crisis. Now, this is not to say the same thing is building out or happening, but what it is pointing out is just this repeats throughout history that housing is an important sector and it's typically positively correlated. And when these correlations start to break, it's not a good sign. And either one, the housing market has to play the catch up and fast, or two, it's giving us a warning sign for potentially a broader market view. Now, it's not only that divergence. This one is known as Dow theory, where you take a look at the transports and the industrial average. Now, things have changed since this originally came out. Dow theory came out. The industrial average is not quite as much industrials anymore, right? You have some big tech names within here, but people do still tend to look at these divergences. And you can see the transports, either one, they need to play massive catch up, or they're giving us signs that there's some trouble underneath the surface in the economy as these things have been cracking lower, and yet the S&P 500 continues to press to new lows. If you actually look at the Dow Jones Composite average right here, it's made up of really three things: industrials, transports, and utilities. And we've seen this, right? At the beginning, going into 2025 February, the industrial average was putting in matching highs right at about here, but yet there was a pretty big divergence between transports and utilities. And as you can see, we did lead into some sell side activity there as well. Well, more clear here is we have a much higher high in the industrial average. This is clearly a lower low, and a lower low here in utilities, sorry, a lower high in utilities and in transports, showing that that divergence is alive and well and currently building. Now, it's only been like a month and a half, 2 months. These things become more dramatic through space and time, but it is something to note because either one, utilities and transports are going to catch up like we just previously discussed, or it's giving us some warning signs that may play out in the later future. If we take a look at value line geometric index, like equal weight, a way to look at equal weight, this one also, right? It keeps on pressing high. It's almost broken to new highs, but you can see it's clearly diverging from the S&P 500. You haven't had the matching high there yet. You've blown through the water of this one, and we've seen many divergences lead to some sell side, lead to some sell side, lead to some sell side in the markets before. So once again, this tells us that, hey, there's some opportunities that are undervalued right now and they got to play catch up, or there's weakness that has yet to really kind of show itself within the S&P 500. If you take a look at the Nasdaq 100 up here, this is the percent of stocks above the 50-day moving average and the 200-day moving average. This is once again showing us that as the market's pressing higher, there's fewer and fewer stocks that are trading above their 50-day moving average, which is a breadth divergence. So once again, are the big megas going to be taking a break, or are they going to consolidate? And is the other names within the index, right, more like an equal weight, going to play catch up and start to crank higher to hold things together? And that's where opportunities lie and potentially warnings lie as well. It's a fine line. Let's take a look at the market conditions. This I thought to be a pretty interesting chart from Tier 1 Alpha that they posted out on X. This is the 3-month correlation between S&P 500 and equal weight, and it's their rolling correlation, and it's dating back to like the 90s here. And you can see times throughout history where this correlation weakens, and it typically results in market volatility. And we're at a place right now where it's one of the lowest in history. And if you go back to each of these times, right, 1999, 2000, right, there was some big sell side activity that took place in the markets. Over here was 2018, right? In 2018, 2019, we saw some pretty big sell-offs there. And then over here in 2020 to 2021, recently in 2024, right, we saw a few pretty nasty 10% sell-offs. Some happened faster than others. I think there was 2 or 3 of them. And then this year, you can see that we had our February sell-off, and then right now the market's pressing all-time highs, and this thing is just completely and utterly just moving down right now. Is it signaling something bigger happening? These are all things that we know in hindsight, but as the market's pressing in new all-time highs, and from what we've seen throughout history, it's not necessarily a great sign when they start to break like this. If we take a look, though, at the market conditions, we're still in positive gamma, which means we're in a regime where it suppresses volatility. Dealers, they buy the dip, sell the rip, volatility suppressed. That's what we've been seeing. That's why everything's been holding up so well, is holding above that gamma flip line. If we take a look at where the call wall is right now, it's currently at 6650, and traders continue to reach up. It's kind of at 6650. Some days it's 6700, and then we kind of got around that 6000 on the Fed meeting. We kind of went under it, came back up. And then we saw a nice bullish move today into and around that 6650, and we kind of just sold off a little bit. Now, going into tomorrow's trading session, our upper daily implied move is 6678. Our lower is 6584. These have been critical to keep an eye on for the last 2 trading sessions. Yes, because it came into it perfectly the prior trading session, and today the same exact thing where the daily implied move was, it started to kind of pause out. So the market's still moving within its expectations as it stands, and I'll update you what that chart looks like for the SPY momentarily. If we take a look at CTAs have been kind of selling off here a little bit, but nothing dramatically by any means. But yes, they're kind of exhaustive, right? So these guys can become sellers, and you got to be aware of that, but we're still holding right above that key level from a systematic standpoint in the market. If you look at vol control funds, they continue to be buyers, right? Suppressed vol. If volatility picks up and we get under that flip line, they can become sellers, and it's just not quite there yet. So overall, before we hop into the expected moves, the market continues to press higher in kind of a one-way fashion. The first day of the month, 10 for the last 3 months, was the low print of the month, which is very interesting. We do have negative divergences building, fractures in the market that we kind of pointed out, and yet there's still this really bullish mania kind of feel to the markets as we're moving into quarter end and Q4. There are all these things taking place. So once again, what am I doing? I'm looking at my portfolio. I'm taking off some that move very far and very fast, reducing the exposure to the equity markets, and I'm only taking new pieces of inventory that are setting up nicely. And like, for example, like Halliburton was a new name, right? That one's not in the greatest trend, so I only did a pilot position, but the stock was getting tight and it looks like it has a possibility to break out. If it breaks down, I get out. If it turns back around, I can get back in. That's how I'm focused to really just stay on what my main motive of my portfolio is to make the most amount of money in the shortest amount of time with the least amount of risk. Let's hop into the expected moves. Expected moves going into tomorrow. We have about 657.22 to the downside. Now I manually did these eyeball ranges, but if you're in the Discord and you use the Asherbot, these will be updated by tomorrow, I guess, Eastern Standard Time. It would be 12, I think, that the update. Okay. And then 667 to the upside, 67.30, which puts us right at that weekly implied move. We're not far from the weekly implied move, people. Remember, 70% of the time this year, actually, it's been more than 70% of the time that we've tagged or exceeded it, and we have yet to tag it. We're not too far off it. So the market still wants to kind of run its bull mouth. Let's go run up into these levels over here where we have the upper weekly implied move, daily implied move. Watch if you're in the Discord or if you have trading tick stuff, you can look at market net flow. And as long as it's supportive of that, awesome. Now I will say that the SPY has tagged its quarterly implied move, but the big product, the S&P 500, the SPX, it is actually still above us at 6688, which is near that weekly implied move, the monthly implied move. And then, yeah, there's the quarterly implied move up in here. So up in this area, right, would be an area to focus as far as reducing risk exposure if you're trading intraday. And that is all I got for you on today's episode, everybody. Hope it helps out, give you some insight. I guess the last thing is, just so you know, this gray line down here, this LWC, this stands for last week's closing price. So if we were to come down over to here, for whatever reason, right, doesn't feel like that's a possibility, but hey, if we come down there, we would be basically flat on the week right there at that daily implied range. That's all I got for you on today's episode. Hope it helps out, give you some more insight into what it is that I'm doing and how I have gotten to where I've gotten with my performance this year and, well, last year too as well. See you later.